Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for October 2017. Let's take a look at key highlights of September. Various Indian macroeconomic indicators dwindled during the month, with Q1 financial year 18 GDP slowing down to 5.7%. CPI inflation inching up to 3.36% and current account deficit widening to 2.4% of GDP. On the positive side, Indian forex reserves crossed $400 billion mark during the month, supported by strong FDI flows. On the global front, China, Hong Kong and UK had one-notch sovereign rating downgrade by Standard & Poor. We continue to remain bullish on India's macro fundamentals even in the midst of lot of incoming negative data. Inflation saw some rebound, and most important to note was the pickup in core inflation to 4.5% in August. Going ahead, most likely inflation will improve as base effects wanes and pent-up demand kicks in. Exports have been facing pressure, with strong rupee hurting its competitiveness. Current account deficit widened to 2.4% of GDP in Q1 financial year 18. Looking ahead, current account deficit could settle down to 1.5% of GDP for financial year 18. Household financial savings, on the other hand, continues to be robust. There has been a 15% CAGR growth in the last 5 years, translating to higher domestic inflows. Earnings growth has been rather split for the markets as a whole. On the Nifty level, earnings as measured by the consolidated PAT for Nifty companies in financial year 17 grew 12%. However, if you exclude the underperforming sectors like IT, pharma, telecom, PSU banks, the PAT growth is 22%. EPS estimates for Nifty index for financial year 18, financial year 19 and financial year 20 are Rs 502, Rs 620 and Rs 696 respectively. As per blended estimates, index is currently trading at PE of approximately 17.6 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. The 10-year benchmark GSEC is hovering in the range 6.61% to 6.62% on semi-annualized basis. Bond yields have been volatile on account of both domestic and international developments. On the domestic front, speculation has been rife that the government will undertake higher spending to boost the economy. This may result in the fiscal deficit being overshot by 25 to 30 BPS. On the international front, the tensions between the US and North Korea worsened when the latter tested a 120 KT hydrogen bomb in early September. Interest rates are coming down structurally. Going forward, repricing of fixed income portfolios at a lower yield poses one of the biggest risks for investors. Investors should revisit their fixed income allocation and should rebalance their portfolios by investing in long-dated buy-and-hold strategies and active accrual strategies with moderate duration, preferably with low interim cash flows, and instruments which can potentially benefit from rating upgrades and spread compression. We recommend investors to allocate 100% of their fresh fixed income allocation to accrual or buy and hold strategies.